This is Profiles in Risk. Hosted by Nick Lamparelli. Every week, we interview those who risk life, limb, fortunes, career, and reputation, and those who work behind the scenes who look to protect and enlighten us about risk. You can find the show notes and other insurance-related content at insnerds.com. That's INSNERDS.com. Now, on to the show.
Welcome to Profiles in Risk. I am your host, Nick Lamparelli. Today, I am pleased to introduce Kyle Nakatsuji. Kyle is the founder and CEO of Clearcover. Clearcover is an auto insurance company using cutting-edge technology to deliver the right coverage when it matters for less. Kyle, welcome.
Thanks for having me, Nick.
There are a lot of auto insurers. So in our pre-conversation, I talked about how excited I was to have this conversation with you.
Yeah.
How did Clearcover start? Why auto insurance?
Oh boy. Yeah. We're not masochists, I don't think, at least.
I'm thinking you are a little bit inside.
Yeah. In a way, auto insurance chose us. So I'll give you a little bit of the origin story of Clearcover and hopefully that'll start to answer that question. So I had the good fortune to help co-found the venture capital team at American Family Insurance back in 2013. And through a lot of sort of work of smart people there that were not me, it was well-timed, and we got to see really the rise of the interest in the insurance tech space as a whole. And so the benefit of that was we got to talk to thousands of really interesting companies who were building great things in the insurtech space and sort of uncovering what the relationship between large insurers and smaller companies and customers was going to look like. And so we spent, like, one of the unheralded good things about being in venture is that you get a lot of time to think. You get a lot of time to sort of listen and contemplate. And one of the things that we learned, which in hindsight was kind of obvious, but it turns out that not a lot of people agree with us on, is that in insurance and in personal lines insurance in particular, there's quite a bit of money spent every year on things that we don't think sort of deliver appropriate value to customers. And so we sort of took a look at sort of what big insurers cared about and what small insurers cared about and what they could work on. And this discovery of, like, well, there's a lot of interesting stuff happening, but you ask people what they really want from insurance, the answer is actually pretty simple. They want the right coverage. They want it around when it actually matters, and they want to pay less for it. And like anything beyond that isn't all that important to them. And what we saw is there weren't a lot of startups who we thought were delivering on that. And some of the big carriers, given sort of what they had in place from a cost structure and legacy perspective, would struggle to deliver on that as well. And so we went to work building a new insurance company that we thought could deliver on those three things. And then when we said, right, what is the line of business where we believe we can have the greatest impact and sort of bring to bear our resources most effectively when delivering those three items, it was auto insurance.
So let's educate our listener base in auto insure. What are the major expenses?
Yeah, your listener base will know this as well or better than I, but I'll try. So essentially, when you think about how your premium dollar breaks down, a big chunk of it gets set aside to pay claims, right? Insurers exist because we make a promise to be there for you when you need the money back because something bad has happened to you. So a big chunk of that money gets set aside to get paid out in claims. There's another big chunk of that money that goes to the expenses of the insurance company. And when you break down what is included in there, it could be distribution, it could be cost of technology, it could be marketing and advertising, it could be a litany of other things that go into running an insurance company. And then there's a smaller bucket, which you could sort of associate with the claims payouts, but we'll separate for now. Loss adjustment expenses, what you have to set aside from an expense perspective to actually pay claims. And then there's profit, right? And what we said is what many insurers set aside for claims is okay. And they have a lot more experience and data than we do in terms of figuring that out. So maybe we won't try and do too much there right now. But where we can really move the needle is that this expense bucket, whether it's sort of old technology, and I can get more into where we really try and make an impact, but there's a lot in there that we think we can use technology and a new business model on the distribution side to shave down. And as a result, we can spend a lot less on that stuff and take that decrease and hand it back to the customer in the form of reduced premiums.
I don't think most people realize how much auto insurers actually spend to acquire a customer.
Yeah.
I don't know what the industry statistics are, but I know Geico spends over $1 billion a year. So that Geico gecko is just everywhere.
He is, yeah.
So it's telling, right? How much they're willing to spend. It's also one of the most competitive lines of business.
Right.
So from a technology standpoint, then my question would be, okay, if you're going to reduce that expense, how do you get in front of the customers with all that noise?
Yeah.
With the Geico gecko just basically screaming at you in his Welsh accent. How is it that you can get in front of the customer when the Geicos themselves are screaming, we have the lowest price?
Right. No, it's an excellent question. So what I'll do is I'll talk about sort of the three pillars that we think sort of separate Clearcover from other insurance companies, and that I'll go into the second one, which is exactly what you're talking about. So the first is sort of, we have the benefit of being a technology company, sort of having been started in 2016. And so what we try to do from an operational perspective is take what are traditionally variable costs in a lot of insurance business and turn them into fixed costs using software. And what we hope that allows us to do is deliver great customer experiences, but using those fixed costs kind of spread out across more customers, meaning you can do it at a lower cost overall, which means lower costs, lower price for the customer. The second thing we do is we think that there's quite a bit of money overspent on sort of buying attention and trust in moments when it's not necessarily relevant to the customer, right? And I think Jeff Bezos has this really fantastic quote where he said, in the old world, you spent 30% of your time building your product or service and 70% of your time shouting about it. And in the new world, that inverts. And in big insurance, we haven't quite seen that inversion. And so what we try to do is we built a technology platform that allows us to integrate insurance with what we call moments that matter. And I'll describe what they are, but essentially places where we feel like insurance is going to be sort of naturally accessible, relevant, or important to the customer. And so by focusing on integrating insurance with these moments, we can then avoid spending the billions of dollars it costs to try and remind them of insurance or get them to care about your brand in the moments when insurance shouldn't matter, right? Whether that's watching a basketball game or the Super Bowl or anything else for that matter. And so we sort of use technology to integrate tightly with those moments so we can spend less on the times when it just doesn't matter to people.
Does that mean social media?
So it's an interesting question because I think I'll tell you that there are probably some moments on social media for some customers when insurance actually matters, right? So like if you are in the market because you want better rates or you want to improve your coverage or for whatever reason, right? If you're searching, perhaps it is a relevant moment to you. Whereas if you're just on YouTube, poking around at the latest video of whatever it is you're interested in, perhaps not, right? And so I think there's a line there that we will have to define carefully. But I don't want to sort of categorically exclude anything that is out there in terms of like digital media advertising, because there are some people for whom that moment matters as well. We just will always kind of stay true to our mandate as a company, which is like we should be sure that the customer we're reaching sort of is in a moment that matters. And if not, we should be very careful.
It sounds like that experience that I think it was Target. Target was able to use predictive models to figure out when women were pregnant before they could figure out that they themselves were pregnant. So are you working on that kind of predictive modeling capability?
So not right now. No, I mean, I think to answer your question more directly, I think there are a lot of ways you can subdivide what moments that matter actually means. Right now, we're focused on a couple big buckets. So the three buckets that we're focused on right now are when you are sort of shopping for insurance, right? When you are out looking for insurance. And the sort of the partners we are working with in that category tend to be the comparison raters, folks like Compare.com and Zebra, who are helping people sort of compare rates and coverages and prices, and what we call neo agents. And these are sort of the entities, sort of digitally native entities, apps or otherwise, that sort of make it their business to help people find different coverage, find the right coverage, find lower priced coverage. And because those are both sort of digitally centric entities, easy for us to integrate. So the first bucket is like shopping in general. The second bucket for us is around the asset itself. And so if you think about you and your car, so this could be shopping for a car, financing a car, refinancing a car, maybe even service. And like all of these activities, if you look now versus 20, 25 years ago, it used to be you go shop for a car and it was you, and then you would go to the dealer, you drive away with the car. And today there's an increasing number of layers, digital layers, between your intent with the vehicle and the actual physical vehicle. And like we can integrate with those digital layers between you and the vehicle to say like, look, if you're on your way to get a new car and you're going to walking through the process, let's make sure you know that you can get the right coverage, you can get a better price with this new vehicle. Like there's these moments leading up to the ultimate where between intent and purchase where insurance can matter. And so bucket 2 is around the asset, the vehicle. And then the third bucket is personal financial management. And it's the same story. It used to be you bank money. And today it's sort of intent to manage your finances, a whole bunch of digital layers, right? A bank, which might be digital itself, money. And we make it our business using our platform to integrate with those moments, because if you're considering your personal finances, it might be an opportunity to check to make sure that your insurance protection is what you need and at the right price.
Where are you currently live?
Currently live in California, and with a handful of partners, numbers growing every day. So the expectation is that you can find us on probably 6 to 8 partners by maybe the end of February, early March, and so across those buckets.
When you say partners, those are like the neo agents and the aggregators. Okay.
Yep. And you can always find us on our own website, but those are where we've been focusing our energy as partners.
I haven't heard the term neo agent.
Yeah. We invented it. It might be crappy.
Is there an example of a neo agent?
Yeah. So you talked with Karn a couple episodes back.
Yeah.
And like I would in my personal taxonomy, Karn and Cover would be a neo agent, right? I think they sort of perform the agency function, but in a sort of different way.
Okay. Interesting. We're all tied together. I love it.
Yeah.
I can now link to that. So anyone that's listening, Karn Soroya of Cover, you have to listen to that one as well.
Yeah.
Okay, so I get it. That's the expense of acquiring a customer is a pretty big one.
Yeah.
But you're a digital company right off the bat. So I've worked for very large insurers, and I don't think people appreciate how much the legacy system is a drain. Is it an expense? Yeah, it's expensive. To me, the bigger part of it is just the time resources. You know, you need data and it takes you 3 days to get data.
Yeah.
That type of thing. So as a a company that's born digitally, you don't have that overhead. So that must be also a pretty significant cost savings.
Yeah, definitely. I mean, it's, and again, like it may not be through any genius of our own. It's more about having the good fortune to be started now and not have to deal with, so having 100 years of history has a lot of benefits, right? And like the average top 10 P&C carrier is 98 years old. And like, let's not forget that there are a lot of benefits associated with being that tenured in the industry. There are some drawbacks, one of which is that you end up carrying a lot of legacy forward with you, and we just don't have to deal with that. So we end up having access to efficiencies that are hard to come by if you don't start now.
100 years, you can build up tens of billions of dollars of surplus, and then price doesn't matter.
Yeah.
You get to that and you're competing against that. So, the sadistic part of you coming into the industry, trying to be disruptive, essentially. Yeah. I think there's a lot of value that can be uncovered. You're using technology to do it. So what was the difference between auto and the other lines of business? So like what in your decision-making process, how did it boil down to? Me personally, I'm probably thinking like auto is like several times the size of the other lines, and that must have been a big factor. But in your words, how did you kind of split the market up?
So this idea of distributing in moments that matter, another way that I had written about it previously, we called it incidental insurance at the time. And it's this idea that like perhaps insurance becomes sort of a more invisible part of these other activities, which have a more natural proclivity to engage with, and like insurance can sort of fit into there in a much neater way. And so we had this overall thesis on incidental insurance, or the moments that matter. And when we looked at sort of how to apply this to the current market, we looked at a few things. So one was volume, right? Like we wanted to make sure that we had access to people who were sort of in market frequently enough that these opportunities through partners would present themselves enough for this to make economic sense. The second thing was that when we looked at sort of where we thought we'd be able to move the needle most effectively in terms of price, right? Or to stand out from the competition most effectively, we thought, look, if we can really affect the expense ratio long-term by both using technology and using this new distribution approach, we're in a market where, there are somewhere between 60 and 70 million shoppers probably in the market in any given year. We're in a market where price really matters to people. It's compulsory, right? It's a product that the government forces you to buy. There's a couple of different behavioral theories I can get into, which were the genesis behind starting an auto. But between these behavioral theories, the size of the market, and the opportunity to work with a wide variety of partners, it just presented itself as the right place to start.
So what did you learn that you didn't know when you first started?
Oh my gosh, everything. Insurance it's not a regular business, right? It's not a regular venture-backed business. It has SaaS-like characteristics, but it's not a SaaS company. It has sort of digital product-like characteristics, but it's not an entirely digital product company. And so like as sort of we went along, I think I can speak for myself. Like I started with the same entrepreneurial sort of, depending on the day, mix of confidence and arrogance, right? About like, well, we'll just do this and we'll grow this fast and nobody's going to believe it. And like, as you sort of get into what you really mean to customers, you realize like that there's a lot more to what growth entails and why you want to grow and what that means for your customers and what that means for your bottom line. And so in addition to like everything you learn about how to run any company, we learned very quickly that this is a unique type of business to run, and we weren't going to run it like any other startup because you just can't.
You also learned about regulators.
We did, yeah.
As well. So you're probably quite familiar with them and the whole concept of how regulators interact with insurance companies. Then you had to deal with it on a face-to-face basis. So again, talking about the how much pain you have to absorb to be an entrepreneur. I would suspect that the regulators probably had a keener eye. They were looking at you as a startup and saying, let's make sure we watch these guys. What was that like in your interaction with regulators?
I don't have all that many horror stories as it relates to dealing with regulators. Like the regulators we worked with in California were fantastic to work with. Like they gave us quite a bit of personal attention and made sure that sort of what we were doing made sense from their perspective. And from our perspective, we had great help outside of that. Like it is a heavily regulated business as it should be. And we had to go through the same hurdles that I think most regulated businesses have to, but no real monumental struggles. Now, part of that is perhaps attributable to the fact that we didn't try and really, so our business model sort of intentionally at this phase is not designed to fundamentally change the underwriting of the product, right? Like if you look at how our product, how we look at risk as an insurance company, it is not substantially different than how the best companies in the market currently look at risk. And we intentionally said, we believe that we will get more leverage out of the advantages we can bring to bear in terms of affecting the expense ratio than we will currently in terms of trying to affect the underwriting side of the product. And like I can talk about why we also believe that from an insurance economics perspective, but essentially we said, look, we're not going to, at this phase in our business, try to fundamentally alter the underwriting of the product. We're going to stick to what works for a lot of folks in that regard. We're going to try and move the needle as it relates to expense ratio, offer our customers lower prices, and open up doors to then think about underwriting down the road.
Right. You do expect, though, at some point from all of the experience that you derive, that will be another bucket you'll probably go after?
Yeah, I mean, I think, so again, like you'll know much more about this than I, but maybe this will be controversial with your audience. Maybe this is good.
We like that.
Yeah. So I don't really believe that trying to drive a marginal profit out of insurance products, particularly personal lines insurance products, is economically sane, right? Like if you are in the business of trying to drive an extra few points of margin, or of trying to create a sustainable profit advantage in the industry, then you will be addressing a niche part of the market, right? Or someone will take away your advantage. Because I'm sort of, again, like we can have the argument, I'm more in the Buffett camp that this auto insurance, sort of many personal lines insurances have commodity-like characteristics. Now, whether or not that's true at a fundamental product level doesn't actually matter. What matters is what the customer believes. And if the customer believes that the product has commodity-like characteristics, then that's how it will be bought and sold. And so like, I'm sort of a believer that trying to drive this, a couple points of profit out of the product is in fact the wrong approach. The right approach is to focus on absolute dollar free cash flow and to manage cost of float. And so that's sort of when we think about underwriting, we will, but it'll be in that regard, not in the regards of like, where do I squeeze a couple extra points out of this segment?
But VCs are jumping in. So that's the conundrum, right? It's there's the whole insure tech field with a lot of venture capital money coming in. I'm dealing with it now. I feel as though a lot of VCs fundamentally don't understand insurance, and they're looking for, the next industry that they can Uberize. You pretty much just said auto has commodity characteristics. I think we can extend that to a lot of lines. So from the VC perspective, what are some realistic expectations that they should have? Because I think they're looking for unicorns, and I don't think there are many to be found here, just because the fundamental concept of the way the product is developed and designed and how the customer buys it. I love the way that you guys are kind of interacting and trying to hit the customer at the right time, but that just means that the customer is kind of driving everything here, and it is really a commoditized product.
So selling a product with commodity-like characteristics does not mean that you can't build a highly viable and successful business. So like books have commodity-like characteristics, and Bezos and Amazon focused hard on category leadership and maximizing absolute dollar free cash flow. And they've built a phenomenal business. Now they've extended that business into a lot of areas. So but again, in our realm, you can look at Geico. So when Berkshire bought the remainder of Geico in 1995, Geico had about $3.5 billion in written. They've now, I think this year was 28 or something like that. And from that moment and before until now, they've not focused on maximizing the profit margin they can get out of their book. They focused on, how do I run a 96 combined on average year over year through cycles, because that generates a cost of float that allows me to deploy capital in ways that are going to generate a better marginal profit than I can try and drive through my insurance business on the margin. And so I believe there are fundamentally, if I were talking to VC, I would say there are absolutely ways to build massive, lasting, and impactful businesses in insurance. But I don't necessarily believe it starts with, I can generate better margins in this particular segment because of this piece of data I have about them.
I need to take you along to the VC conversations I have. That kind of nails it in a lot of ways. It's the same kind of conversation that I have. And, what's the better mousetrap, and trying to, slice markets into different ways, and trying to put the jigsaw puzzle together and create a tower to show how you're going to get to $1 billion in premium. And at the end of the day, the Buffett approach to it is probably the most fundamentally sound way of doing that. I almost think that it's not possible to build a fundamentally strong company if you have underwriting losses year over year, and to find out whether you're segmenting the market correctly, you run the risk of doing just that. And it's almost better to, kind of play it safe from the underwriting side. So yeah, that's really interesting. So you said for 2018, you're going to expand through the different neo agents and other aggregators. To do that, do you have to become an admitted company in the states that you're offering the product?
So in California, we are an MGA, and we have a carrier partner who's fantastic and a very large reinsurer who backs us up. And so that model works for us in California, and we'll replicate it in other states. There are some states where we may seek to become an admitted carrier as well. I think that decision has more to do with timing of state entry and sort of the plan of how aggressively we would like to scale the business, and less to do about the hurdles of getting that done. Because frankly, scaling an insurance carrier is capital intensive. Scaling an insurance company with carrier partners and reinsurer partners quickly in the auto market is also expensive. So we don't have a path around sort of running an expensive business. And so we will use the carrier as a tool in conjunction with our partners to make sure that we can get our products in as many people's hands as reasonably possible.
I suspect long-term, your goal would be to move into other lines?
It's a very interesting question, because I don't know that the answer is necessarily yes. And Geico, again, provides an interesting case study, because certainly they are in other lines other than auto, but I think they've also strategically avoided some lines which they thought might be harder to enter without risking their cost structure advantage, right? And so if you look, Geico doesn't manufacture a homeowners product, right? They sort of, part of their cost advantage is derived from effectively being a pretty monoline company. And there are arguments in favor of that as well. So like I to be honest, I don't know that we've decided. I think the distribution platform and model scales to other lines of business, but we have an economic decision to make down the road.
Yeah, I can imagine that's going to be difficult. I've always wondered why Geico didn't sell homeowners insurance.
I mean, I believe, don't quote me because I wish I had the data in front of me. I do not. They are one of the, if not the largest brokerage in the US, because they have Geico Insurance Agency, which sells a lot of their property products, and that tends to work for them. So like, first of all, I'm talking about a scenario that we have many bridges to cross and mountains to climb before we even have to concern ourselves with this kind of thing. But it is sort of the question of like, do you just enter other lines of business is, I think, a lot more complicated than can you?
Yeah, very interesting. You will be presenting at the Insurance Nexus Analytics Conference in Chicago in late June. What are you presenting on?
I'm a panelist for Customer is King, Personalized and Automated Customer Engagement. And I might be a controversial panelist because our idea of customer engagement is a little different than everybody else's.
Do you happen to know who else will be on the panel with you?
I don't. I should, but I do not.
Is the customer king?
Yeah, of course. I think, there's another great Bezos line where most companies claim to be customer-centric. Very few are. Most are competitor-centric or technology-centric.
Yeah.
And so we have these three things, which I'll say again because they're important to us, right? The right coverage when it matters for the lowest cost possible, right? Like that is our proxy for customer centrism. And every decision at the company, whether it's how much money do you raise and where do you spend the money, to do we make this copy change or this copy change, right? Big to small is all driven by those three things, and those things have to be balanced. Right? You can't just naturally have all of them. It doesn't take long to find examples where you could easily trade lowest cost possible for like what you might deem to be sort of moments that matter. And so for us, it's striking that balance from the biggest to the smallest decision in the company. And so like absolutely the customer is king. That is our proxy for making sure the customer is king or queen, and sort of ensuring that all the decisions we make throughout the company keep that in mind.
Yeah, it reminds me of when Southwest Airlines, when they first got started, they were the low-cost airline. And I think one of the investors of the company approached Herb Kelleher and said, hey, American or United or whatever airline he was talking about, they're like double the price of one of your tickets. You should raise your prices. And Herb astutely said, we are not competing with them.
Yeah.
We're competing with the bus.
Yeah.
And so that is customer centric.
Yeah, absolutely.
And I have a personal story where I gave a pitch to, I think it was a VC investor, talking about flood insurance and our rating model and how, we had this particular rating approach. And he said, well, what if they're paying more? What if they're paying double? And I said, well, I think we're going to stick to our rating model. And if that's the price, that's the fairest price. We think that's the fairest price that can still generate a profit. And in the long run, it'll help us build a brand. And we lost that pitch. And afterwards we had to truly consider okay, we're going to have to take some kind of economic model of where the market sits and readjust our rating for that, because we didn't think the VCs would actually buy into a model where we're leaving so much money on the table. So
yeah. You've probably had your fill of it by now, but one of the sort of greatest resources that I've been able to access as an entrepreneur in the insurance space is you can get, so the Berkshire shareholder letters are all free, but you can get them on Kindle consolidated for $2.99. And you can highlight and you can reread, and you will see kind of in many years where they come out and Buffett will come out and say, we ran a 92 combined ratio this year, and that was too low, right? Like he will write it to his shareholders, like we were too profitable last year and we will fix that next year. And
that's amazing.
Yeah. Isn't it amazing? And that's real customer centricity, right? Like
yeah.
that is this is how we build our business.
Yeah. Yeah. I agree 100%. It could, just when you think of auto insurance that's cheap, I automatically think Geico. I know you're going to make me change my my branding. I'm going to think Clearcover, but you got your work cut out for you for sure. Would you say you've mentioned Buffett and Bezos a couple times? Would you say those two are two of the most influential investors and entrepreneurs that you've come across?
Definitely in my readings, I suppose. I haven't had the pleasure to meet either of them, but yeah, definitely. I mean, I think if you look at Buffett's trajectory through insurance, it's and we've only talked about Geico and personal lines, right? If you look at their portfolio of insurance businesses, like clearly they've sort of done some really incredible things over the last 70 years. And Bezos, I think, sort of one of the things that I really appreciate about what they did is like you should go back, your listeners should go back and read the 1997 shareholder letter, which he attaches to all of his shareholder letters as a reminder of what they stand for as a company. And it's amazing to read the 1997 shareholder letter today in 2018 and listen to him talk about the transition that's happening in online commerce, and think about how far behind our industry is and how much opportunity is still out there for sort of insurance and online commerce to really find their way together. I think they've been sort of playing tag, right? And sort of figuring out ways to work together here and there. But like, we just haven't seen, I think, that mesh of online commerce and insurance yet the way that you've seen it in other retail industries.
Yeah, I've had some guests on that would say insurance can't be bought online. It's too difficult.
I don't know that they are wrong. Our hypothesis is just different. And, we'll find out if one of us is right or both of us are right. And, I think there's a very reasonable argument that it depends on what line of business you're talking about, certainly. And it also depends on the customer within that line of business, because there are some customers for whom that personal touch will be forever important. And there are some customers for whom I think they'll be able to sort of satisfy their needs to the right extent online. And maybe a healthy mix of both is where we're ultimately headed.
We need to make you more controversial. You're supposed to say, no way, online all the way. Those guys don't know what they're talking about.
Yeah, sorry. On that one, I can't. I would be lying if I said I didn't believe that. It wouldn't be customer-centric of me to be categorical in that regard, right? You just have to listen to what people ultimately like. Right coverage, moment that matters, lowest cost possible, like, depends on the customer. And for some customers, that mix might be different.
Sure. So you made a very challenging move from investor over at AmFam to entrepreneur. What was that like?
I thought I knew what it was going to be like, and I did not. And that doesn't mean it was good or bad. It just meant my expectations were incorrect. They're very different jobs. And I think being a venture investor in many ways prepares you for the job of being an entrepreneur, in that as a venture investor, your job is to make decisions. And you have to make decisions with incomplete information, and you have to use sort of the lattice work of tools available to you to make good decisions. I think as an entrepreneur, you have similar challenges, but the cycle time is decidedly faster. And so while you're sort of prepared with tools and frameworks, and like you have been trained in decision making through your time as a venture investor, you have to do it on a much quicker cycle time. And then there's 100 other things you didn't have to do that you have to figure out how to do on a daily basis. So it's been a very interesting transition. So here's the thing that maybe your venture investor listeners won't love, but I think venture investing, the team at American Family is incredible. I loved working there. I also think venture investing is a team sport the way that track and field is a team sport, which is to say that the score at the end tends to be the sum of individual performances. And entrepreneurship is a team sport more the way basketball is a team sport, where like the team needs to sort of lock arms in coordinated effort to achieve the objective. And that transition is an interesting one. And it's one that I've actually enjoyed. And it's been a pretty big difference in terms of going from VC to entrepreneurship.
That's quite philosophical there. I suspect at some point you may dabble in investorship again. I suppose now you'd have a little bit more sympathy.
Yeah, empathy maybe. Sympathy, I don't know. I'd have to find it.
What was the roughest part, from your personal experience going through this? Probably I'm sure being an investor had its challenges, but it's, probably more cushy. You're probably working a lot more hours now. Could you walk through like some of the rough patches that someone who's listening, who's thinking, I want to start a company, what were some of your speed bumps?
Yeah. So there's this thing in entrepreneurship that I didn't know that much about. And I don't think it's unique to our company, although it could be. But we call it the existential crisis half-life. And what I find is that when you start a company, you have an existential crisis on a very frequent time frame, maybe 1 or 2 a week. And then as you go, the time between existential crises tends to extend like by 2, so like if you had one once a week when you started, maybe you have one every 2 weeks, a month in, and maybe you only have one every month, a couple months in, and maybe you only have one every 6 months. But like they never go away. The time between them just shifts. And so like when you're brand new, you're like, I have this amazing idea and like, I can't believe how great it is. Let's start this thing. And then you go out there and you're like, oh crap, like 7 other people have this idea and all these things I thought were true were not true. And like, should I even be doing this? And then the existential crisis turns from that to like, well, I feel pretty solid about what we're trying to build, but can we actually build it? Like I need these 3 partners to line up. And if the 2 don't line up along with a third, then they all 3 fall apart. And so like, you always have these existential crises. They just tend to get further apart. And like, I probably shouldn't speak to how often we've had them and exactly what they are, but I can tell you we've had many and they are stressful.
We have them. Absolutely. I know exactly what you're talking about. And I didn't think of it from a Halflife perspective, but it's true. When you first start, everything is you figure out how much money you have, you figure out how much money you're going to spend, you figure out when it's going to run out, you kind of draw that roadmap. And so every day is like we're one day closer to running out until, okay, the day we run out has actually kicked down the road a little bit. So now we can worry a little bit less about that. And then all of a sudden it reappears again.
Yeah.
Like, oh, we have that problem again. What are we going to do about it? It is like a Half-Life and it changes all the time. So I can completely sympathize with that. That's wild.
I made this horrific mistake when we started the company, which was I said, this is really stressful. What I'm going to do is I'm going to keep essentially a diary next to my bed, call it a journal. And every night before I go to sleep, I will write down in a journal everything I'm fearful about. And I'll just dump it out of my brain. I'll get a great night's sleep. Like, this will be fantastic. And it had the exact opposite effect. All it did is it served to remind me of all the things I was terrified of immediately before I went to bed. And I'd stop sleeping. And so like the journaling habit lasted a couple weeks before I realized that just didn't work for me.
All the stuff you packed away and then it all came out and now
right before sleeping.
Oh, I forgot that that's important. Oh, how did I forget about that?
Exactly.
That's crazy. Team. How important is your team and finding the right people?
More important than anyone could write or talk about. I'm very fortunate to be part of a team that is incredibly capable and does many, many things that I couldn't possibly do. So like when we hire, I won't get into it in detail, but we have very specific hiring methodology. We hire for culture fit, but culture fit defined very carefully. I think, Enron had core values and we all saw how that turned out. So like we're very specific around what culture fit means and sort of mapping our core values to the individuals we hire. And the second thing we look for is superpower. And I think the reason we do this is a lot of businesses hire for the absence of weakness, not the presence of strength. And we do the opposite. And I think in doing that, we've been able to bring a lot of people in the business who shoulder burdens that not only could I not shoulder, but I couldn't possibly understand. And that's made all the difference.
That's fantastic. I've worked for so many companies that would say things like, yeah, great candidate, but they didn't know SQL. Like, you teach them.
Yeah.
They're clearly smart. They'll pick it up.
Yeah.
And, the little decisions like that just did not make sense to me. I agree with you. Hire for strength. That's really good. I want to transition over to something, to the part of the podcast where we get a little bit more personal. What books have been influential in your career? We have a listenership that loves books, always asking about them. What have been a few that have been influential to you?
The Berkshire letters I mentioned, those as an insurance professional have been immensely helpful. How to Win Friends and Influence People, Dale Carnegie. I think he wrote it in like 1927, and it's as true today as it has been ever before.
Amazing, huh?
Yeah.
Perennial.
It's an amazing book. High Output Management by Andy Grove. So we manage companies using OKRs, which are just an extension of management by objective. And like Andy Grove sort of is the source material behind most management theory today. What else has been influential? Trying to think of books that I've reread. We have a Super Forecasters is a more recent book that if you're sort of into decision making, you should read. It's really fantastic. And trying to think there's this great book by a guy named Nick Epley. He's actually at the University of Chicago. It's called MindWise. and talks about, there's a lot of books on behavioral science and biases, and like Ariely and Amos Tversky and Kahneman. And Epley builds on this idea of like how we misunderstand the minds of other people. And it's just an incredible book. So Mindwise is always one I give away a lot.
So I've been really looking forward to asking you this question because we're simpatico. I think both of our companies are in very similar places right now. So I feel like we're probably going through a lot of similar stresses.
Yeah.
What tools or techniques do you use to stay productive? I find that to be probably the most challenging thing. I was just, right before I got on the phone with you, I was talking to someone and I said, I am busy 12 hours a day. I could make it 20 if I wanted to. And there are days where I get nothing done. I'm just a lot of busy stuff. And at the end of the day, I'm like, I don't know what I got that moved this company forward an inch.
Yeah. And I'm probably the wrong person to give advice on this. I admittedly am less organized than I should be. I keep lists. It's the only way I can keep track of stuff. We have a couple frameworks that we use for prioritization here. So like one of them is this tool that is essentially a cost reversibility matrix. And so you sort of have either something as high cost or low cost, and it's highly reversible or not reversible. And then we use those quadrants to sort of say, all right, how quickly can we make these decisions and get them off our plate? So if it's low cost and highly reversible, I don't want to talk about it. Make the decision, move on. We'll deal with it later. So like that's one. And then we also use the Eisenhower box, which is a tool that allows you to say, it's a similar matrix, except the axes are important and urgent, right? And so you sort of force yourself to say, as I'm making my list, what's important and urgent? And let me get to that right away. What is important but not urgent? Let me set that aside and make sure I get to it. And the most dangerous one is what is urgent and not important? And let me find a way to triage that immediately, because you can waste a lot of time on that quadrant.
Yeah. I love that. That's also in 7 Habits of Highly Effective People.
Yeah.
From Stephen Covey. So I'll note that as well.
Perfect.
How can people get a hold of you, Kyle?
So website is clearcover.com. And there's obviously you can check out insurance stuff there, but if people need to get hold of me directly, k@clearcover.com is my email. You can email me and I'll be as responsive as possible.
And we'll also put up on the show notes the information to the Insurance Nexus conference if people want to meet you in person. I'm hoping to do that. We get to learn about the customer as king, and we're partnering with Insurance Nexus to help them out for that particular conference. So as we figure out who your panel members are, we'll post that information as well.
Yeah, I should apologize to my panel members for not knowing them. But I'm looking forward to the conference. Yeah,
I am as well. And we'll, as I mentioned, we'll put it up on the show notes for the audience if they want to learn more about it. Kyle, we learned a lot. I feel like we're both going through the same thing. So we'll definitely stay in touch, and we want to learn more about Clearcover. And so as you guys grow, I think it's important to let's get a pulse of where you guys are and how much ass kicking you guys are doing.
Just we have a long way to go, so keep your fingers crossed, and we'll keep you posted.
Hey, you know, one thing I have to say, one thing you bring to the table is I get a sense of humbleness, which I think is missing in a lot of startups that we're seeing, especially in insurtech. There's a lot of hype out there, so it's a pleasure to hear someone say, "I don't know," or "We'll see," or "We don't have the answers to that," because going through my experiences, we don't have all the answers either, and the only way to learn is to take, as one carrier told us, the only way to learn is you got to take some live fire.
Yeah.
So you're doing that now, and really best of luck in everything you're doing, and hopefully we'll see you in June.
All right, Nick. Thank you so much for having me.
My guest this week has been Kyle Nakatsuji of Clearcover. Kyle, thanks again.
Thank you.